Right, so we're live. Hi, and good morning, everyone. I'm just going to check that we are alive indeed, because a couple of times it happened to me that we weren't. So, hi and good morning. Hopefully, everybody's all right this morning, Wednesday. This is our clinic. So, it's Yarka from Stepping Stones Accountancy. If you guys have any questions during this live, definitely let me know. Just type into your comments, into the comments, and we'll cover your questions live. So today I've got Emma Smith from Grace & Co. Mortgage Advisors. She is absolutely amazing. I mean, she'll talk to you about all the details later on. But Emma helped me with kind of deciding what I'm going to do with my properties, but we'll talk about it in a bit later. So let me just get her in. Hi, Emma.
Good morning.
Good morning. Thank you very much for coming and for your time today.
You're very welcome.
So I will give you a little introduction. But the stage is yours. How did you come up doing mortgages, and why do you do what you do?
Why do I do what I do? That's a very good question. So I started in financial services straight after I left school. I joined Alliance Leicester, for those of us old enough, or mature enough, shall I say, to remember when Santander was Alliance Leicester. And I used to work on the counter, and then I gradually moved around and became an investment advisor and a mortgage advisor, and then a branch manager. Started travelling around a couple of different branches, kind of troubleshooting, bringing performances of branches up. But I knew at that time that we were in an unregulated world and the opportunities to move forward were quite limited. So then I moved across to Barclays, where we worked with some high net worth clients. And we moved, and I was a regulated supervisor then, bringing financial advisors from an unregulated to a regulated world, and there's lots of different competencies that they need to demonstrate. So once that job had done, I was kind of displaced. So I moved across to a company called Money Partners. So I've gone from high net worth to maybe more complicated, difficult sort of financial cases. And then that was just before the financial crisis in 2007, and we were all made redundant. So at the time, when I found out I was pregnant with twins, really the only way to regain my sanity and continue working was to kind of pick the area of speciality that I enjoyed, which was mortgages, which is why Grace & Co was set up. So it enabled me to continue to help and advise people on mortgages and protection, whilst then I was a full-time mum as well. And that worked very well. So Grace & Co is now coming into its 11th year. So we've got a really good steady base of clients who regularly refer me to their family, friends and colleagues. So yeah, and that's the area of speciality that we have chosen to be in.
No, to be honest, I mean, I started my practice when I was on maternity. Like you said, to keep my sanity going. Yeah. I think a lot of ladies, of new mums can probably find it. I mean, I don't want to be generalizing, but from what I'm talking to other ladies who are around me, they go through very similar things.
Yeah, absolutely. I think any new parent will know how important it is to leave a certain environment and just go and have a grown-up conversation and hot drink every now and again. So, yeah, very important.
Okay. So because obviously you talk about mortgages. If we just kind of touch up on what you've done for me, which I really, really appreciated it. And it's not necessarily something that I would go to a mortgage advisor for. I mean, I would think about going to a mortgage advisor, say, I want to buy a house, or I need to find an advisor to help me with getting a mortgage for that. But what I came to you with is, I've got 2 houses. We're thinking about getting a third one. Do we sell the 2 houses, or do we rent them out? And you just kind of got back to me with calculations and kind of made it very clear as to if we want to do this, this is what happens. If you want to do that, this is what happens. So can you just talk about roughly the thought process, and how you come to that?
Yeah, absolutely. I mean, when people traditionally talk about mortgages, they automatically assume that they only need a mortgage advisor when they are looking at buying a house. And we have a number of clients that do just that, whether they're doing that for the first time and they really don't know what the process is as a first-time buyer, and we help them go through that entire house buying process, who gets involved and at what stage they get involved, because often within these processes there are solicitors involved and estate agents and, you know, people that you're buying from, people that you're selling to, so it can be a very sort of complicated scenario. And if you've never been in that situation before, it's hard to know at what point these people come in and what they do and when they kind of leave the process. So we kind of talk first-time buyers through that process, and obviously people who are moving house, because the mortgage market has changed so dramatically in the last 2 years and will continue to change as regulation sort of updates itself. But your scenario is certainly not unique. I get a number of clients that come to me and say, this is what we like to do, this is what I think we need to do. And actually what we do is spend the time looking at your individual circumstances, looking at the fact that it really isn't sometimes as straightforward as selling one property and buying another one. You can restructure your property portfolio sometimes and put your existing residential mortgage onto a buy-to-let and release some money, which can then be used for a deposit on the onward purchase. So it's really just educating clients that what they think they need to do and need some help from a mortgage advisor about whether that's possible or not, is maybe opening up some other avenues to them for consideration, because sometimes people want to hold on to their properties and build up a portfolio so that they can, you know, have an income later on in life. And it's just letting them know what is available to them.
No, that's totally true. I mean, I always thought about my house to be my pension potentially, and now realizing how little that actually is. I need more. Don't we all? But yeah, with the percentages and, you know, how do you? Because obviously you've got some sort of calculator that you kind of put it into to come up with the sort of suggestions that you then come up.
Well, I think there's a couple of different channels that come into play. So the first one is really educating clients about the real fundamental differences that lenders look at between buy-to-let lending and residential lending. So residential lending, when you're saying to a mortgage lender that this property is going to be where I live for the vast majority of the time, is classed as residential lending, and the fundamental process that they will go through as a responsible lender that's governed by the Financial Conduct Authority is to evidence that they are being very sensible about what they're prepared to lend you. Now, historically, that used to be a very straightforward calculation about looking at what income comes in, and if you're employed, that's taken from your last 3 months' pay slips and a P60, and then any commitments that you have, like car loans, personal finance, hire purchase, anything that you're contracted to pay each month.
Nursery fees.
Exactly, yeah. So that's deducted then from what your salary is, and then a standard income multiple used to be applied. So that was very sort of black and white about what a lender could do. And as years have gone by and as regulation has changed, what we see now is that lenders, the vast majority of lenders, have a built-in affordability calculator. So what they have to demonstrate is, when they know what comes in and what goes out, that they are happy that you have got a certain amount of money left at the end of the month to be able to sort of feed and clothe and, you know, put the heating on and what have you. But the other thing that they're very aware of, and this is where compliance has come in, that interest rates have been low now for a very long period of time. And although we're about to go into, you know, we're in a recession, we've had a global pandemic, we don't know what next year is going to mean for some people as far as job security is concerned. But what the Financial Conduct Authority is very mindful of is at some point in time, we may see a return of some higher interest rates. So what they need to demonstrate to the regulator is that it's not only affordable for you now, but it will be affordable to you in the future if and when interest rates do start to increase again. And that's where this affordability model has become more important, by assessing what your free income is and what proportion of that you could then use for an increased mortgage payment as and when that happens.
That's so good.
It is. And this is...
Yeah, go on.
Sorry, I was just going to say this is very different kind of lending situation to buy-to-let lending, where your income to a certain extent is irrelevant. You have to demonstrate that you have some level of income to sort of put up with any void in rental payments that you have. But as long as you can demonstrate that you have some level of income, the focus for buy-to-let lending is then all around the rental potential of that property. There's a very different sort of proposition.
No, what I was going to go and say, I mean, when I first bought my first house, the mortgage advisor I had, if I was to follow his advice, I would have absolutely nothing. All my money would have gone on the payment of the house.
Yeah.
And as soon as I sort of figured it out, and I was like, screw that. Like, I'm just going to go on my own. I'm just going to, you know, do my own research because I can't rely on this guy. And he was recommended by the estate agent I was actually kind of hunting for a house with. Yeah. And I was like, well, if that's who they recommend. And I didn't really think, he just put me off mortgage advisors altogether, to be honest.
And I think that's a real shame. Yeah, I think that's a real shame because obviously as mortgage advisors, you do have to be qualified and authorised, and we continually go through continued professional development to show that we can do the job that we do. But I think that goes back to the second thing that I was going to say to you, is not only knowing lending criteria and what a client will need for evidence to the lender, but I mean, I've had years experience in the mortgage market, so I automatically, when I'm speaking to my clients, it's almost like there's an automatic filtration system going on, and depending on what they want to do and what their overall goal is, I know what lenders will do what will be happy with certain circumstances and which ones won't. And you can automatically start to include and exclude certain lenders from that calculation. So you can only get that really with a lot of experience. This is the bit where you say you don't look old enough, Yaka.
No. So, say, just considering my experience and now knowing you as well, I'm starting to switch my sort of, you know, opinion of mortgage advisors, because you just were so approachable and so helpful. Oh my goodness. I still need to kind of persuade my other half, but hopefully he's not watching. No, he's not. I guess, what would be your 3 tips, or why should people go to a mortgage advisor, to you, rather than doing it themselves?
Yeah, I think that's a really good question. And I think the key things are, a lot of people don't understand what a mortgage broker does and what the difference is between a mortgage broker and just going back to your bank and seeing what you can get through your bank. So I think this is the key thing for people to kind of get their head around. So a couple of things. So first of all, you could have been with your bank for 20 plus years and feel that there is some kind of loyalty that you have there. And that is very much not the case now. In very, very few circumstances do you get preferential interest rates or preferential lending policy because you have an existing sort of business with that financial institution. That just doesn't happen. So the key thing really to understand is that your mortgage is often going to be the biggest financial commitment you're ever likely to make in your life. So before you make a decision about what you're going to do with your mortgage, it would seem appropriate to try and gather as much of the information, the relevant information that you need before you actually commit to something. And the key difference really is, if you go back to your bank, they will be classed as single tied. So what will happen is that they will be able to give you sort of advice and information about the range of products that they offer and they alone offer. If you go to somebody like myself, who is a whole of market mortgage broker, that means that we work with in excess of 90 different lenders, all with their different sort of wrap of interest rates, different benefits, the different rates that they provide. So what you often find is, on the same circumstances, that it's financially more advantageous to actually move your mortgage somewhere else. And that can, over a 2, 3, 5 year fixed rate period, that can equate up to thousands of pounds that you can save yourself. And even if you may, for personal reasons, you choose to go somewhere else, which is absolutely your decision to do so. At least you do that with all the information to hand, rather than making a decision without knowing all of the information. And I think the other thing to add on to that is, because there are whole of market advisors like me up and down the country, and because we give huge amounts of business to financial institutions, they often give us preferential interest rates or preferential fees, which you wouldn't actually get if you walked through the door of the bank yourself. So I think that's something to bear in mind as well.
Okay, cool.
One little add-on that I would add at the moment is, obviously, I think we've all heard the word, these are unprecedented times, quite a few times now. It is not unusual for me to sit on the phone to a lender for over an hour before they answer the phone at the moment, because I fully understand that they're kind of having to deal with social distancing restrictions and all of the challenges that brings. But if you are a hard-working person, you are not going to have the time, effort, or energy to come home from work and then sit on the phone for an hour waiting for somebody to answer your call. So we are able to do that for our clients and sort of answer any queries or questions and provide paperwork on your behalf rather than you doing it. So what we do service-wise, is a bit above and beyond.
You do the calls, you spend the hours on the phone waiting. It's a bit like me and HMRC.
But the number of times as well that I've dialed someone, and then because I'm quite disciplined, I will then do some emails while I'm on hold, and then they answer, and I think I've forgotten who I called now.
I know.
My first line is, who are you? Where are you?
Yeah, exactly. That's what it is. But that's really good. So, what about, obviously you're not doing all of this, none of this for free. So how does it work fee-wise? What should they expect?
Again, this has been a really good thing as well, where regulation comes into play, because everything, all the costs that are associated to your mortgage are all declared and explained to you before you actually sign on the dotted line of your application form. So for clients, that's an amazing thing. It's a really positive step as far as regulation is concerned. So mortgage brokers are remunerated normally in a couple of ways. So the first thing is whether you charge an individual fee. So at Grace & Co, we charge £349 on the receipt of your mortgage offer, because we feel that's the fairest way to do it. That's at the point where the vast majority of our work is done, and we then hand you over to normally legal solicitors to sort of complete on the transaction. It isn't the cheapest fee, it's not the most expensive, but we feel we pitched that right with our clients. We also then get paid what's called a procuration fee from the mortgage lender that we place you with. And again, that's all declared in the paperwork that we go through with you before you submit your application. And to give our clients some peace of mind, we obviously let them know as well that behind the scenes, we have a compliance department that check through our files, check the advice we give. We have to evidence the research that we have done to prove to our compliance team that we have made that decision to place that business with that lender for all the right reasons.
Okay. So it's fairly approachable. It's not, you're not talking thousands and thousands of pounds.
Not at all. And I think that's a misconception as well when you sort of engage with professional people. That it is a cost-effective thing to do. And obviously, for me, a personal challenge is the fact that if I'm charging a fee, I have to prove to you that you are going to be getting some worth out of that. And that's either by the time and effort and energy that I am going to save you by doing it yourself, or the expertise and actually sourcing a more competitive interest rate for you that you wouldn't have necessarily found yourself.
Yeah, exactly.
That's the competitive nature in me.
No, that's really good, because I think keeping your fees kind of out there, available for people before they even contact you, I feel it's really important, because it's like accountants, the same thing. It's like, accountancy fees are very, very expensive. But actually, if you talk to someone, you need to get through the hurdle of actually picking up the phone and actually making the phone call. Whereas what we do on our website, we've got the fees right out there.
Absolutely.
So we can make a decision before they even get in touch with us.
Yeah. And I think our industries are very similar as well, Yaka. When you're talking to people about their biggest financial commitment or their account, dealing with people's money, very emotive for them. So to be able to make the topics that we discuss very approachable and deal with it in a chatty way and not make it sort of overwhelming, and to have a competitive pricing structure, then, you know, that's beneficial for both me, because I'm looking to grow my business, and therefore it's beneficial for my clients because they often then refer in family, friends, colleagues, etc., etc.
Exactly. No, I totally agree.
Mm.
Oh, wow. So one last question. When it comes to the mortgage percentage,
Yes.
well, actually, I have 2 questions.
Okay. Well, you said
Mortgage percentage. What's the sort of average interest at the moment?
Well, that's very difficult, and that's another thing about educating our clients as well, because there's a couple of things that will determine the kind of interest rate that you pay. The first one is obviously whether it's residential or whether it's buy-to-let. Buy-to-let interest rates generally are a little bit more expensive. But the second one, and this is a vital thing for lenders for a couple of reasons, is the amount of deposit that you are putting down. Because the bigger the deposit that you have, the more security there is for that lender. And then traditionally what happens is that they are much more competitive with their interest rates. And you will then find that they are a little bit more flexible, maybe with their lending criteria. And certainly their affordability becomes a lot more flexible when you come to the party with a bigger kind of deposit, a bigger percentage deposit. I think at the moment, it's not unusual. I spoke to one of my clients yesterday who's got quite a low mortgage. So anything lower than 50% at the moment, you are easily picking up interest rates that start with a 1, even if it's a 5-year fixed rate just crept into the low 2%. So it's a very, very competitive process, still some really good interest rates to have. And I think that's probably at the moment, people feel, because we are in these unprecedented times, that this is actually a financial crisis, when actually the mortgage interest rates have remained quite sort of stable at the moment, and they are quite low. So the challenge that we have at the moment is helping our clients understand if they have been impacted by COVID, if they have had changes to their income because they've been employed and they've been furloughed, or they have normally received annual or quarterly bonuses or overtime that maybe some lenders have not taken into consideration now, right the way through to the self-employed people. And if you're sole traders, some people or some lenders are only looking at the self-employed income payments that have been issued. They're using that as their level of income. And obviously, we know that's only based on a certain percentage of your previous profits. So that's a little bit more limiting. So yeah, all of these things get taken into consideration for us to find the right lender for you, and ultimately the interest rates. The interest rates are still really quite competitive at the moment.
Oh, that's good. When you said 1, I was like, yes, please.
Yes.
So what would you actually recommend to people, say they think that they may be paying too much on mortgage?
Okay, so the
to have a look at paying less, or
so I would say the key thing really is, if you haven't reviewed your mortgage in the last 2 years, the key thing that I would say is dig out everyone who's got that drawer or that cupboard or that folder at home that's got all the paperwork in. Just pull out your most recent statement and your last mortgage offer that you have, and just remind yourself, familiarise yourself with what kind of mortgage interest rate you are paying and when it comes up for renewal. Because one of the key things that I will say to people at the moment is really 6 months before your rate is due for renewal, it needs to kind of be on your horizon somewhere, because
6 months,
3 months before, that's when you need to be really approaching a lender and either renegotiating your interest rate where you are with your current lender, or looking to move it somewhere else. They've got still real big time constraints out there, not just with lenders, but with legal departments. I've known solicitors who have closed their books at the moment because of the sort of ban on stamp duty that's had an increased level of people wanting to move house. So time scales at the moment. Familiarise yourself with
6 months. So if anybody, so every time you pretty much remortgage or you buy a house, just make sure that you put that 6 month sort of notification in your calendar to start looking. I can see somebody's watching, say hello. If anybody's watching on replay, say #replay. So come and join us. This is Emma from Grace & Co. We're talking about mortgages. Very exciting topic. Not, but
it really is.
But Emma is making it so much approachable, so much easier to actually understand. She talks you through, and she's the most bubbly person I've met in a long time. We can talk forever.
We really can.
We can. One last question. Timescale. When it comes to timescale, as to how quickly or how slow mortgages are at the moment, especially during COVID.
Okay, so right at the beginning, when we first went into lockdown in March, the major challenge that we had around social distancing was trying to get a valuation on the property. So actually trying to get a surveyor to physically be able to visit a property. The challenges that we have now is that in the vast majority of cases, the administration that's involved in any kind of mortgage application is done in large call centres or large offices. And the vast majority of these people have now had to work from home. So there's massive GDPR issues that companies have had to deal with.
Yeah.
So there are still lags in time. And it's very difficult to be able to say you generally have to take this long because there's so many different components that come into play. I've had a case that had a mortgage offer within 9 days. I have another case where we started the application 6 months ago, and although they had a mortgage offer on the 26th of October, because the solicitor was snowed under, they kind of dropped the ball and then completing 10 days past the date that we wanted to. So it's a very frustrating place to be at the moment. So I would definitely say timescales. If 6 months is the key thing, it needs to be on your horizon, and certainly you need to be putting in an application 3 months before your rate is due for renewal. A mortgage broker will be much happier with you sat with a mortgage offer for a period of weeks, waiting for you to come out of any penalty, rather than scurrying around trying to get a mortgage offer at the last minute.
Yeah. With people switching mortgages, because the only thing that potentially may be stopping me is if I switch mortgage, don't I then need to pay the early repayment fee?
Yeah, absolutely. So this is when I say you need to kind of familiarise yourself with the interest rate, because certainly if you've got a fixed rate, the likelihoods are that there will be some kind of redemption penalties applicable. So what mortgage brokers are very good at doing is tailoring those in. And if it's the best advice for you, 6 months before we'll be having the conversation about what your plans are, what's changed with you personally, your finances. Within 3 months, then we will have identified the right lender for you and your own personal circumstances and submitting an application. And then within the next 3 months, we'd then be engaging with all of the necessary people, whether it be you, the estate agent if you're moving, the solicitor, to ensure that transaction is done in a timely fashion. Which is the client that I had who had a mortgage offer since October. He came out of penalty at the end of November, so we wanted him to complete on the new one on the 1st of December, which was the next working day. So the solicitor wasn't quite up to speed with that. So yeah, we're kind of a few days behind, but we tend to be quite good with dates. But the other thing as well is if your mortgage is historically it's been going for a long time and there's a penalty applicable, if your circumstances have changed, with our compliance, we have to show you whether it is a good idea for you to move. And if there's a penalty involved, you have got to take that into consideration. But sometimes on a number crunching basis, in some cases, it is best to move somewhere else, pay a penalty, because you are then
saving yourself come cheaper long run.
But that's the importance of compliance. You have got to evidence that is the best thing for your client to do.
Yeah. Oh, wow. Yeah, I did kind of think that might be the case. But because I don't know whatever mortgage I've ever looked at, there were always early repayment fees.
Yeah.
But what you said, I mean, we've talked about it as well, is that it might actually still be efficient, although you have this penalty to pay.
And this is why understanding people's needs is very important, because I've got a number of clients who are self-employed and they keep cash around for tax bills. So you can use that in offsetting facilities, so you can reduce your mortgage by offsetting the interest rate. Some people know that they're going to move in a year or 18 months' time, so don't want to be tied in but haven't found the right property. So in that case, picking a product that doesn't have a redemption penalty might be best for them. So again, it is all about understanding that client's real individual needs and circumstances, and then offering the best advice to them on their individual needs.
Yeah. Oh my goodness, Emma. So what's the
Mortgages.
best way how to magic hands. So what's the best way to get in touch with you?
So the best way to get in touch with us is to either call me. So I don't know if there's any way that we can put my details up, but my
Yeah,
mobile
we can put in the
number there.
comments.
Perfect. So mobile number, email address, best way to get hold of me. In the new year, we will be doing some social media work. So yeah, so we can eventually get out there and
You're on fire. Have you got a website yet?
shh, Yaka, Nick, come on. It's fine. It's all
It's pretty good.
coming soon.
Because you've got office in Downend.
Yeah, so we're based in Downend. That's all about. We've just been rebranded, so that's going to then be all signed up in the new year. The website's going live, and then we're going to have some social media activity. So yeah.
Oh, exciting times!
Very
A great start to 2021.
Isn't it, Chef? Come on.
Screw 2020. Let's start looking forward. Yeah, 2020's been a bit of a washout, wasn't it?
Hasn't it, Chef? Onwards and upwards, though.
Yeah. Oh, Emma, thank you so much for coming.
You're very welcome.
Sorry, I've taken a bit more time.
It's all good. You know what we're like when we get started.
Yes. No, I appreciate it very much. If anybody's watching and you guys have any questions for Emma, shoot them away, put them in the comments, and Emma will either pick it up later or I'll make sure that I kind of put those messages towards her, and we can then get back to you as soon as we can. And that's it. That's Emma from Grace & Co., our lovely mortgage advisor. So thank you very much, Emma. Have a lovely day, and I'll talk to you soon.
Speak to you later. Bye.
So hi everyone. So this was Emma. She's, like I said, she's the most bubbly person I've met in a long while. Yeah, thank you very much for watching. Let us know your comments. If you got any questions for her, I'll make sure that I forward them on to her. And that's it for today. That's Jarka from Stepping Stones Accountancy, and I'll see you next week with some more real conversations. Bye for now.